Guys, here's some history on NIO. 2020, 43,728 cars. 2021, 91,429, over double. This year, Q1, 25,768, which is roughly 103,000 for the year on pace for. Now, does that mean 103 is the number? Not much growth from last year? Guys, there's a million reasons why that could happen. This whole COVID thing could be a big part of it. Our job is to look at NIO from a long-term perspective and not worry about the small month-to-month, quarter-to-quarter changes that happen in the company. They make a really good-looking car. China is the fastest-growing middle class, a booming economy. So if you can buy NIO at the right price, it's a great idea to kind of pick up some shares. That's the whole idea we're trying to teach here. So really quick before we go into anything, these are the analyst expectations for revenue for NIO over the next 10 years. You can see major growth. 64%, 68, 38, 38, flat, 23, 16. Now remember, as time goes on, the number of analysts giving projections out this far decreases. So these ones are probably covered by one analyst completely. And don't forget that analysts tend to be wrong over long periods of time. They're able to edit their estimates up to the day of earnings announcements and revenue announcements. So keep this with a grain of salt, but it just shows that everybody's projecting big revenue growth for NIO, right? So let's go in right now, take a deeper look into NIO using our 8-pillar process. So we go to our software, type in NIO. NIO. Okay, this is the 5-year chart for NIO. Boy, it really surged. It hit a high of over 60, and now it's currently at, the price is currently at $16.39. It's a $25 billion company market cap-wise. All right. So for a company that's going to sell, even on a high year this year, 200,000 cars, that's a hefty market cap for that company. But some out there would say, well, wait a second. Tesla was, I get it. Tesla had a lot of growth. It grew into it. We won't get into that right now, but NIO might be the Tesla of China. So let's go further. Here's the interesting part, guys. Our 8-pillar process. First pillar is we want the 5-year PE to be under 22.5. There is no 5-year PE. Why? They have not made money overall in the last 5 years. So with that, pillar number 2, we want the return on invested capital being greater than 9%. It's negative. Why? Because they haven't made cash flow in the last 5 years. Now, does that mean you avoid the company completely? Not necessarily, guys. Because remember, every investment is the present value of all future cash flows. And even a company that's losing cash flow today, if you can find a way to make money and make lots of it, you could still have a price that you're buying for today that makes a lot of sense. Okay. Pillar number 3, we want revenue growth. So we go to the income statement. We look at the last 5 years, and sure enough, they went from no revenue to $5.36 billion with major growth. All right, that's good stuff. We want profit growth for pillar number 4. So we scroll down to the net income level. They lost $739 million, and then they only lost $592. Check mark there. So they're losing less money. But look, guys, loss. Again, you can still have a value play on companies that are losing money. The question is, can you see the profit that's going to happen? And that's what matters. Pillar number 5, shares outstanding. Guys, the shares outstanding here are even. Chinese companies tend to have foreign companies tend to not issue as many shares as others. So that's a positive there. Pillar number 6, we want to compare the long-term liabilities to their free cash flow. So let's go back to the main page and look at their 5-year average free cash flow. Negative $830 million. So this is an X automatically because you can't multiply a negative number to get a negative debt number that you want, unless the company has negative debt, which would be more cash on hand by the tune of 830 times 5 is $4 billion. So unless they have a net cash position of $4 billion, it really doesn't make any sense, right? So that's fine. That's great. But again, I think you're seeing as part of this, this is not a company you're valuing based on traditional methods of, oh, the company makes X today and therefore we can take, no, it's got to be based on the future and only the future, okay? Pillars number 7 and 8 have to do with free cash flow. And again, guys, you look at free cash flow here on this company, negative, slight positive, negative. So in the last 5 years, they've averaged a negative $830 million a year in free cash flow. So I can't come up with pillar number 8, which is we usually take the 5-year average free cash flow, multiply it by 22.5 to get some sort of value idea. We can't do that here. That's fine. So let's just skip right to our 8 pillars tab. It does all the math for you. It's all X's and that's fine. So I guess the question becomes, guys, how much to pay for this company? Remember, I will repeat this till you're blue in the face, till I'm blue in the face. Every investment is the present value of all future cash flow. We don't know the future. We can only make estimates. Now, with our stock analyzer tool, we can make these assumptions and it'll tell us based on these assumptions, here's how much you pay for the company. So first one is revenue growth, and I'm picking a 10-year analysis. Let's do revenue growth of 20, 40, and 60% per year. Now keep in mind, guys, at 60% per year for 10 years, that would make the company generate $550 billion in revenue in year 10. 550. And if you remember, look at our revenue for 10 years from now, it was $60 billion. I'm only putting this in here because I want to show you guys this drastic difference. Even on 20% per year, 20% per year for 10 years times $5 billion is $31 billion. So the number is probably somewhere between 20 and 30% revenue growth. But let's stick here to 20, 40, and 60. Profit margin. Guys, they've had no profit. Typical car companies make mid-single digits in profit. So let's go 3, 5, and 7. Free cash flow margin, we're going to do the exact same thing. PE. At that point, it probably still has growth potential. So I'm going to give it a little bit higher multiple of 15, 17, and 19. But finally, guys, I'm actually going to change my desired return to 15% because this is a lot more. Remember, we also are going to have losses along the way, which we can't factor in the stock analyzer tool. So I need a bigger margin here for my margin of safety. The more speculation involved, the higher your margin of safety needs to be. I can make the argument of 20%, but let's just show here this company at 15% returns. All right. So based on this, the low value is 3. The high value is 140 and the middle value is 26. Guys, this $3.50 is based on 20% revenue growth per year. It's based on 3% profit margin. These are very, very low numbers. You're probably watching this going, what the heck is going on here? But that's what's important about looking at these numbers. You have to sit there and go, oh my gosh, is this even possible? Thank you very much.